Hello, hello! In this video we are taking a look at Disney. We haven't examined the stock since a while now and it's down almost 3% today, giving us an even better price. Now what has been happening with Disney lately? As you'll see, it's down almost 50%, approaching 50% since its 1-year high. If you take a look at the 3-year chart over here, you will see that the company was once doing great and then all of a sudden it started going down again. It has a lot to do with the overall market, but also what is actually going on with Disney, which we are going to examine, because Disney has been much into politics lately, and some of their pretty much recent films are actually reflecting that. For instance, they created The Strange World, I believe was the film, and it was a massive flop, a disaster at the box office. Now, you will see here that the company had a budget of, the film had a budget of 180 million, and it only grossed 18.6 million over the holiday weekend, which is absolutely horrific here for a company spending almost $200 million. And the studio is obviously expected to lose, I'd say, at least 100 million in revenue. Now, Strange World was criticized for being a very, very woke film, and this means that it's a lot about politics, and families and parents don't really want their kids, for the most part, to be much into politics. Frankly, they want an easygoing movie that doesn't really attempt to brainwash children one way or another. And I'm pretty sure this plays a very, very important role here. And as you'll see, one of the shareholders, one of the big shareholders here, an asset management firm, accuses Disney's woke politics of ruining brand. That's a story that happened like 2 months ago, but it's interesting to see because as you'll see, the current CEO, Bob Chapek, his approval is down from an impressive 77% to an embarrassing 33% because of the woke stuff. And as you'll see here, this asset management company sent Disney a letter outlining ideas for improvement, and especially the number one priority, improve guest satisfaction and stay out of politics. Very, very important thing. As you are still seeing Disney creating like woke Marvel stuff, Star Wars, huge Disney busts confirm merchandise sales, and as you'll see here, there is a continuation in terms of what is going on with the woke policy here. Kevin Feige's woke Marvel approach is not only failing at the box office and on Disney Plus, but with merchandise as well. And this is what basically the article is pointing out here, that even the merchandise sales are actually going wrong for Disney here, which for a brand like Marvel is not great to see. Now, amidst all this, what we need to examine is it maybe an opportunity to buy the company as it's going down in value, especially after all these things that have been happening with their movies and their politics and all that? Because at some point, if these things keep failing, maybe they will have to change course and actually create movies that will make sense and people will actually watch. But what about the company? What about the stock here? Like, is it a good buy? So, in terms of the P ratio, as you'll see, it's still 50, so it's still not cheap. Disney used to be a very expensive company. Now it's getting a little bit better, but over here, for instance, it used to be close to 160 in terms of the P ratio, which is super high. Now it's coming down a lot, but still sitting at 50. And the price to free cash flow is even more, 150, not even going down here that much, frankly. And of course, because the company's stock price seems to be expensive, you're currently looking at the company pretty much issuing a ton of shares. Although recently, since it's getting a little bit cheaper, they stopped issuing that many shares. But if you take it back to 2018, they were issuing a ton of stock. Like in the past 3 years, they are not issuing that much though. So it's probably okay in terms of this kind of metric here, if you're buying today, that is. And in terms of liabilities, take a look at this one. Total liabilities to free cash flow is very, very high, indicating that the company is probably not very solvent here, or at least they are not generating as much free cash flow as their liabilities are. We'll examine that in a little bit more detail. And you'll see that the revenue growth is actually going up. However, their net income growth is going down, so they were not making as much as they used to. Now, there was the disaster in terms of the COVID stuff, of course, which definitely hurt Disney there. But still, their net income is substantially down from the previous years, and I'm not sure this has really corrected in terms of the stock price yet. And in terms of the free cash flow growth, again, the same story, being down significantly, like insanely, compared to what it used to be. The total equity growth of the company is still okay because, again, of the outstanding shares that the company has been generating. You kind of see the same pattern over here, and then it kind of stays the same after 2018, indicating that it's basically outstanding shares that increase the equity of the company, understandably. Okay, so if you see the margins here, you will see that the net income margins are sitting at a level that is fairly low over here. It used to be significantly higher, but again, this has to do with the company's struggles lately. So, we don't necessarily expect that this will continue for the company, although with the current work policies is another issue that could potentially lead to the company having these struggles for a long time yet, if they don't reverse course, or at least if they don't change how they produce their movies, and they don't really pay much attention to entertainment and not politics that much. In regards to institutional traders for Walt Disney, you will kind of see that there is an increase actually in total ownership that is in the last date reported pretty much since this happens quarterly. There is still an increase, an overall increase in the total ownership that institutional holders have for Disney, although in the previous, as you'll see here, in the previous quarters, it used to be even more. But there is an increase from the past couple, I suppose. You can kind of see the whole story here. It's still a little bit less than what it used to be like in 2020, for example. And for the most part, there is slight changes. Like nobody's really buying too much or selling too much in terms of Disney. They overall seem to be holding, as you'll see here, the top people like Vanguard, BlackRock. Very, very minor adjustments here, like 2%, 1%, 2.2, 3.4. So nothing much happening over here. But what about the financial statements is what I want to examine next. You will see that the revenues of the company have grown from 60 billion to 82. Yet the problem, net income, 12 billion, 11, and then actually going to 3 because of the couple of years in the pandemic. It was a disaster here for Disney. And again, the balance sheet will basically tell you of the story that you would expect to hear. The fact that the company has been issuing a ton of shares. And by issuing shares and adding some capital to their coffers, I should say, they are getting some equity here that gets increased, total equity that is sitting at $108 billion right now. Of course, they are still making some money, but not as much as they used to in the previous years. Okay, so what about the cash flow statement? Now, the cash flow statement here, you will see that it begins with a net income of $3.5 billion, and then it goes down to $6 billion after the adjustments, goes up, I should say. After the adjustment for about $5 billion in terms of depreciation and amortization for the most part. And remember, this is non-cash expenses that are added back because this is the cash flow statement, so it's about the cash stuff. So if there was an expense that was a non-cash expense, it gets added back here. And in terms of the cash from investing activities, it's mostly capital expenditures, the vast majority of it, as you'll see. And the financing activities, $4 billion, 4.7 actually, for debt repayment. So the company is actually using some of its cash to pay back some debt, which is interesting to see and important. Now, the free cash flow of the company is $1 billion. It used to be 9.8 at some point, so it's going down. Now, it has been going down because of what we told about the pandemic, like really, really hurt the company here, for sure, really brought its numbers down. You can kind of see back in 2018, things were significantly better, but from 2019 and on, things started going south, really. And if you take a look at the balance sheet again, if we go back just quickly, you will see that their total liabilities are sitting at almost $100 billion. So this is not a company that can afford not making a ton of money, really. They have to do a lot of free cash flow, and they have to continue doing a ton of free cash flow. They have a lot of liabilities here that they need to be serving through the years, and they also have a lot of debt that they also need to be serving. So they can't continue doing like $1 billion, $2 billion. Like 10 is more like it. But they were doing 10 back in 2018, which is much more fair and makes a ton more sense. So it has been a disaster for the company, which has gone down 50% though. And I'm not sure that is a lot, frankly. As I said earlier, I'm not sure it's a lot for buying the company. I'm not sure, but to make it sure, what we're going to do is actually use our stock evaluator, of course, and examine what's the price to pay. Of course, this is fantastic here because we can see what it makes sense to be paying for the company, which of course it has been growing a ton, like last year, for instance, because after you are coming down so much, at some point you will grow. You will probably go back to your normalcy, and The expected revenue growth that we're seeing from analyst estimates is sort of like 7 to 8% for the upcoming years. I'm going to go 6, 7, 8 here. And the net income margins that I'm going to be using, again, you will see they are all over the place. The company used to do 20%, which is frankly awesome over here, back when things were right and great for the company. And then it started going down, so it's very tough to come up with a net income margin that makes sense here, because we don't necessarily know what the company is going to be doing in the upcoming upcoming couple of years, for example, because they have also been making some disasters lately. So it's tough to actually decide what to use here. So I want to be using some values that are representing different scenarios. So I will go with something like 5, which is a disaster scenario, and then something that is more like it, probably something like 10%, and maybe 15% if I'm feeling frisky here. And in terms of the free cash flow margins, again, the company in normal things does something like 80%, 90%. I'm going to go with 80, 90, and 100, the usual stuff, and 13% for my annual return. And let's see what we get. I'm interested. So, as you'll see, of course, this changes significantly because of the net income margins that we used here, which, again, we can't be too sure what the company is going to be doing in regards to this. But you will see that the max price to pay today, that is, for Disney, given the net income margin of 5% over here, is $31, 10% 73, and high of 127 for a 15% net income margin, which could happen. It's not out of the question, actually, to happen. So, to my eyes, actually, what makes sense here is something probably near these two, to tell you the truth. I want to be conservative, and I don't really have a reason to buy Disney at an expensive price. Frankly, there are so many other opportunities around. So I think I would probably like Disney here sort of somewhere near the 50s or maybe even the 60s, frankly. But at 87, and the risk that the company has right now amid what is happening with their productions, I think I would avoid for now. Yet still pay attention, because this is obviously a massive company, and they can definitely keep growing tremendously through the years, and it could be a fantastic long-term investment. But I just feel that for now, I think I need to wait a little bit. I think this can keep going down. Again, if you take into account what has been happening with the company and their failures, their recent failures, I think I'm going to be waiting on this one. But do tell me what you think about Disney, guys. I'm very curious to hear your opinions on this one. Leave a comment below. I'd love to hear about it, and leave a like and subscribe if you are new around here. I'll see you in the next video. Bye-bye.